Trading indicators. Traders are very hygienic. They clean up and they take baths. Trading indicators. Now, I know that as traders, we all love indicators because there's something about indicators that's attractive. And one of the things that we find attractive about them is that we tend to want to use something that will, to some degree, do our thinking for us. And indicators, because there are, to some degree, sophisticated formulas behind the indicators, we think that it is something that is interacting with the market and potentially outsmarting the market, giving us a slight advantage in our trading. And that may be true, in fact, to some degree. However, trading is still going to come from your gut, from your understanding of the market, and from your ability to manage your emotions and your psychological tenacity. As you may have seen in some of my trading examples, I don't lean on indicators a lot, but I definitely do use some indicators, and nor do I discourage the use of indicators, because many of you may have your own favorite indicators that you like to use that you've picked up somewhere, and that is absolutely perfectly acceptable. Trading indicators are intended to complement your discretionary trading analysis tools. But again, I'd be very reluctant to simply just rely on one or two or three or four indicators independently. Like any analytical tool, trading indicators must be used with discretion and should not be used in isolation. Further to that point, there are countless outfits that are selling simplicity. And trading is not about simplicity in the sense of having this indicator or this formula do your thinking for you. Trading is much more than that, as we've seen throughout this course. The use of an indicator is typically uniquely interpreted by the individual user based on your own personal trading methods. And when I say that, what I mean by that is that I could have a room full of people. I could have a room of 30 people, and I could teach you all an indicator system, teach you all a very specific list of rules associated with trading that indicator, and you would all go home and trade it differently. And you would all uniquely design it based on your perception of the market, your understanding of the market, and the way in which you feel most comfortable using that particular piece of information to help you to drive your trading decisions. One of the indicators that we're going to look at is average true range. And average true ranges is is somewhat popular. And we're just going to look at a unique way in which I like to see it used. And I have had a lot of success with using average true range in my trading protocol. The market moves in various dynamic ranges on a daily basis. We call them intraday ranges. And the average range is constantly changing depending on the time of week, the month, the year. You know, Monday, whether it's a Monday or whether it's a Wednesday or a Friday, depending on the time of the month, whether it's the end of the month, squaring of positions, or the end of the quarter, triple witching, quadruple witching, time of year, August, vacation time, Christmas time. So the market, the ranges are constantly changing. And these ranges are often moving relative to what the market is, again, anticipating to happen in the future. So they may be pricing in a geopolitical scene or an economic report, or many of the other factors that provide impulse to the market. Range volatility, or the size of the range, can differ considerably when comparing one currency cross to another currency cross. And you have heard me refer to the difference in ranges between, for example, the British pound US dollar cross versus the Euro US dollar cross. And the British pound US dollar cross moves in much larger interperiod ranges, or daily ranges. When I say interperiod, I mean, for example, if you break it down into 1 hour periods on an hourly basis, the British pound will move in much larger ranges than, say, the Euro US dollar or the Australia US dollar cross. Average true range calculates a currency cross's average daily range for a specific period. I like to use the last 5 days or the 10 days on a daily chart, and you can set your parameters based on your own trading preferences. How does average true range help me? Well, it will help, for one, it will help you to discern whether the ranges for a specific currency cross are expanding or contracting, whether the market's volatile or less volatile, because clearly the more volatile that the market is, the more optimal it is for trading. Tight ranging currencies can have advantages for certain trading techniques, but generally less opportunity for making pips. And what we mean by that is that when a currency cross is in a very tight range, then it's probably consolidating. And if it's consolidating, we have to trade it differently than if it was ranging. So in a consolidative period, we have to look more at, for example, daily highs and daily lows, the support resistance level, trading within those parameters, which usually lends to less opportunity to see the currency pair break out into trends and get ourselves into medium to longer term trades. Tight ranging currencies can often be choppy markets. They'll often stop you out and return to your entry with the sole purpose of ticking you off. There is a technique that I like to use for the advanced trader, and when a currency will move beyond the maximum projected range, it will often set up a retracement or counter trend move, which is a higher risk trade, but I make a lot of them, and I have a very good success rate with them, and I'm going to show you that trade. Calculating average true range. You can simply read through this because I'm going to show it to you graphically in just a moment. Here's how the average true range is calculated. Now we're doing it manually here, but we'll do it in the software itself, and I'll show you how to do that. The vertical lines here separate the days. So this is Friday, Thursday, Wednesday, Tuesday, Monday, and so on. Now on Friday we had non-farm payrolls, but the average true range on this day was 189 pips. From the high to the low of the day was 189 pips. Previous day, from the high to the low was 148 pips. The previous day, from the low to the high, was 97 pips. The previous day, the low to the high was 55 pips. Previous day, the low to the high was 121 pips. Now, if we were, of course, to add all of these, divide by 5, then we would have the average range over the last 5 days, which would be calculating our 5-day average true range. So our 5-day average true range is 122 pips in this case. Looking at the next slide, I'll show you how this average true range is calculated. Now, in the previous slide here, we're looking at a 60-minute chart, and we've broken down each of the days. Now, in the following slide, it's a daily chart, and each one of these candlesticks represents one day of trading. Now on this particular software, on the Fibonacci Trader software, tell them Chris Laurie sent you. On the Fibonacci Trader software, we have it's automatically calculated for you. So if I pull up my average true range indicator, it's automatically calculated. So here, if we see the values, it says 122.9 repeated pips, so 123 pips, as we have calculated. We will calculate 122, but the software calculates 123 as the average true range over the period of the last 5 days. Now you do that on a daily, you pull up this indicator on a daily chart. Now what this indicator down here represents is, you see how price, this line is moving up and down? Well, when price is up here, this is our pip scale over here. And you see our pip scale, right now price is at 123 pips. Down here we're at 103 pips. And down here we're at an average true range of 80 pips. Now if you see that the indicator is down here below 82 pips, that means we're in very, very tight ranges. You see these tight ranges right here? How price just consolidates? During that period, the average true range was less than 80 pips. And as you see here, as the daily price moves are bigger, and if we look at the average true range corresponding with that, we see an increase in the range to above 120 pips during that period. Now when we're trading, we can simply refer to this indicator, which we'll find on the daily chart. We refer to this indicator to determine whether the market is moving in very wide ranges, if there's a lot of volatility and a lot of liquidity pushing price around, and that is a more trader-friendly trading environment. Again, looking at a daily chart, we can also calculate the 10-day average true range, which simply means this, that we're just calculating the average range over the last 10 days. And in this case, we see that over the last 10 days, taking over the same period as the 5 days, plus 5, that we just looked at, we see that it's a lower number. It's 115 pips. Personally, I like to use the last 5 days. But here I just wanted to show you that we see a lower number in this case. But we see the differences here. Let me show you something. You see a range trades in a price trades in a small range, and then it increases, small range, increases during the trends, small range, increases. Once again, this corresponds with our theory or our principle that, or our understanding of the pattern that price will consolidate and then move out, consolidate, then move out. Whenever price moves out of its ranges, then the ranges expand. Consolidates, then moves out. Consolidates, moves out. Okay, some choppy consolidation, moves out. Now whenever it's consolidating, we see the average true range decline. When it's trending, we see the average true range move up. Now look at this period right here. You see how we're having a declining average true range for the period? Now, if you look down below here, we see that we are in the 7th month, 8th month, and getting deeper into the 8th month. Well, typically what we see in the foreign exchange markets is that liquidity and volatility declines during August, particularly late August. It really declines because most traders are on vacation, except of course maybe in Australia because it's not their summer holidays.